Investing in the stock market can seem intimidating, especially for those without a background in finance or investing. However, Peter Lynch's book, One Up on Wall Street, provides a beginner's guide to successful investing that anyone can follow. One of the key points Lynch makes in his book is that professional investors often fall short when it comes to picking stocks. This is because they are limited by their industry expertise and are often too focused on large, well-known companies. On the other hand, amateur investors can have an edge by paying attention to their own experiences and the world around them. Lynch also introduces the concept of a tenbagger, which refers to a stock that increases in value by 10 times or more. He explains that these opportunities can be found by researching companies in your own backyard or workplace, such as those you are already familiar with or have insider knowledge of. Additionally, Lynch discusses the importance of doing your own research and not relying solely on the opinions of others. By gathering information and analyzing it yourself, you can make informed decisions about which stocks to invest in. Finally, Lynch touches on the idea of taking calculated risks and being willing to bet on racehorses or less popular stocks that have the potential for high returns. However, he also stresses the importance of diversifying your portfolio and not putting all your eggs in one basket. Overall, One Up on Wall Street offers valuable insights and practical advice for anyone looking to invest in the stock market, regardless of their level of experience or expertise. By following Lynch's simple yet effective strategies, amateur investors can increase their chances of achieving financial success. Chapter 1. Investing in the stock market can be a daunting prospect, especially for those without professional expertise. However, contrary to popular belief, amateur investors can have an advantage over professional analysts and investors. By being less constrained by industry limitations and regulations, amateur investors can potentially identify and invest in high-growth stocks before they become popular with the professionals. Before investing, there are 3 important factors to consider. The first is whether you have experience investing in assets, such as a house, which involves similar research and patience as investing in stocks. The second is to assess whether you have extra money that you can afford to lose, without compromising your financial goals or needs. Finally, it is important to evaluate whether you possess the qualities of a successful investor, including patience, decisiveness, flexibility, and the ability to do independent research. While it is essential to do your own research, it is equally important to avoid impulsive decision-making based on gut instincts or emotions. Rational analysis and the ability to admit mistakes are critical to successful investing. By following these guidelines, amateur investors can have a shot at beating the professionals and achieving financial success in the stock market. It is possible to turn a modest investment into a tenfold return with careful consideration, research, and patience. Chapter 2. Investing in the stock market can be a daunting task, especially if you're not sure where to start. However, paying attention to your environment can help you spot investment opportunities that you may have overlooked otherwise. The author of this piece suggests that great investment prospects come up 2 to 3 times a year and are often found outside of the stock exchange. As a professional in your industry, you have an advantage in spotting investment opportunities. You have knowledge and insight into your industry that can help you identify rising demand for a product and which companies have the resources to profit from that demand. Additionally, as a consumer, you see products and businesses entering the market and becoming popular. Keeping an eye out for promising companies can allow you to invest early and benefit from their growth. However, before investing, it's important to make sure that the success you're predicting will have a real impact on the company's profits. A wildly successful product owned by a massive company may not contribute much to the firm's overall balance sheet, whereas a small company can profit incredibly from a popular item. To determine what to expect and when, you need to establish which of the 6 categories your chosen stock falls under. These categories are slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Fast growers are the category that most tenbaggers fall into, meaning firms that can up their value tenfold. By paying attention to your environment and utilizing your industry knowledge and consumer insight, you can spot great investment opportunities and potentially benefit from their growth. Just make sure to do your research and determine which category your chosen stock falls under before investing. Chapter 3. Investing in stocks can be a lucrative way to build your wealth, but it's important to do your research before jumping in. A company's name, the state of its industry, and insider behavior can all provide valuable clues about whether a stock is a good investment opportunity. Firstly, pay attention to the company's name. Companies with simple or unremarkable names can easily go unnoticed by investment analysts, providing an opportunity to buy stocks before they become popular. Similarly, companies involved in dull or unattractive industries, such as waste management or funeral homes, may also be overlooked despite their potential for growth. The industry in which a company operates is also a crucial factor to consider. A company with few competitors or that produces unique products has a higher chance of dominating the market and maximizing profits. In competitive industries like technology, it's important to look for companies that benefit from using technology rather than those that manufacture it. Lastly, examining the company itself is essential before investing. A company that's a spin-off of a larger enterprise is more likely to succeed, as parent firms only spin off companies with potential. Looking at who's buying the company's shares can also be a useful indicator of its potential success. If employees or the company itself are buying shares, it's a good sign that insiders have confidence in the company's future performance. By paying attention to these factors, you can spot great investment opportunities that might otherwise go unnoticed. Remember to also consider the 6 categories of growth potential when evaluating a stock to make the most informed investment decisions. Chapter 4. Monitoring a company's earnings is a crucial step in making informed investment decisions. When investing, the bottom line is how much money a company earns and whether it continues to generate profits. A company's earnings determine the value of its stock, which can rise or fall with fluctuations in earnings. To determine if a company's stock is a good investment, you should also consider the price-to-earnings ratio, which indicates how long it will take to earn back your initial investment. The ratio should be equal to or lower than the company's growth rate for the stock to be considered well-priced. However, earnings alone do not tell the whole story. You should also look at the company's plans for future earnings. Are they working to cut expenses, close unprofitable segments, or expand into new territories? These are all tactics that can improve a company's earnings and make it a better investment opportunity. Monitoring a company's earnings is not only essential before investing, but also after you've invested. Keeping track of a company's earnings can help you make informed decisions about when to sell your stock or when to continue holding onto it. In conclusion, paying attention to a company's earnings, price-to-earnings ratio, and future earnings plans is crucial to making informed investment decisions. Chapter 5. When it comes to investing in the stock market, it's important to know which stocks to avoid. One way to approach this is to steer clear of popular stocks and industries. These stocks can gain a lot of value based on hype and excitement, but this can be short-lived and often doesn't reflect the company's actual profits. So, it's important to avoid investing in something just because it's the hottest thing on the market. This also applies to stocks that are marketed as the next big thing, as they often fail to live up to expectations. Another type of stock to avoid is the whisper stock. These are companies that promise big solutions or claim to be the next big cure for a problem, but often lack substance and are unlikely to live up to their claims. In addition to this, be wary of companies that are making acquisitions to diversify their business. These acquisitions can often be expensive and fail to bring the expected return on investment, which is sometimes called a diversification. Lastly, be cautious about investing in companies that rely heavily on just a few customers. If a company sells a large percentage of its products to just one customer, the loss of that customer can have a huge impact on the company's earnings. So, it's important to do your research and avoid investing in companies with this kind of business model. By knowing which stocks to avoid, you can make more informed decisions when it comes to investing your money. Chapter 6. Research is an essential part of investing, and knowing where to find reliable information is crucial. Your broker is an excellent resource for obtaining relevant information about a company, including financial reports, publications, and surveys. By monitoring price-to-earnings ratios and insider buying, brokers can also provide valuable insights into the health of a company. Once you've received the annual report from your broker, you can quickly evaluate the company's financial health by looking at the consolidated balance sheet. This will give you an idea of the company's assets, liabilities, and debt. Additionally, reviewing the 10-year financial summary will help you understand the company's recent performance. If you have more specific questions or want to dig deeper into a company's operations, you can contact the company's investor relations personnel. These individuals can provide valuable insights into the company's operations, financials, and future prospects. You can also visit the company's headquarters and attend its annual meetings to gain a better understanding of its operations and make valuable connections. Finally, remember to reevaluate the company every few months to ensure that its stock remains a good investment. By staying informed and regularly monitoring the company's performance, you can make informed investment decisions that can help you achieve your financial goals. Chapter 7. Investing in the stock market can be a great way to grow your wealth, but it's important to be realistic about your expectations and take the right steps to increase your chances of success. One key step is to create a diverse portfolio that spreads your investments across multiple promising stocks. This reduces your risk and increases your chances of hitting a big winner. Before investing, be sure to do your research and choose stocks from different categories, such as fast growers, stalwarts, cyclicals, and turnarounds. Another important aspect of successful investing is knowing when to buy and sell stocks. Two periods that are great for buying stocks at bargain prices are between October and December, and during any stock market crashes. However, it's important not to panic and sell just because a stock price drops or the economy stumbles. If you still believe in the company's long-term prospects, it may be wise to hold onto the stock and wait for the market to recover. Only sell if the company is performing poorly with no indication of improvement. In conclusion, diversifying your portfolio and considering your timing and reasons for buying or selling stocks can help improve your chances of achieving annual returns of at least 12 to 15%. Be sure to do your research, stay informed, and make decisions based on sound financial reasoning rather than emotions. Chapter 8. Options and shorts are financial instruments that are often touted as alternatives to buying traditional stocks. However, the reality is that the risks associated with these instruments are far greater than the potential rewards. Options give investors the right to purchase a stock at a predetermined price on a certain date. While this may seem like a good way to buy a stock at a discount, the limited time frame of the option contract can make it difficult to see a return on investment. Furthermore, repeatedly buying new option contracts can become expensive and erode any potential gains. Shorts, on the other hand, involve borrowing stocks from an investor and then selling them to someone else in the hopes that the stock price will drop. However, if the stock price increases, the investor is responsible for buying back the stocks at a higher price and returning them to the original owner. This can lead to major financial losses and potentially even put the investor in debt. In general, it's best to stick with traditional stock investments that have a proven track record of generating steady returns over time. While options and shorts may seem like a tempting way to make quick profits, the risks far outweigh the potential rewards. As with any investment, it's important to do your research and understand the risks before committing your money. Summary. The book's key message is that you don't need to be a professional investor to succeed in the stock market. By paying attention to new and fast-growing companies and monitoring their earnings and plans, you can make successful investments. However, you should avoid options and shorts as they can lead to major financial losses. The actionable advice given is to summarize your research about a stock in a 2-minute monologue. This exercise will help you fully understand the company's situation, including why you want to invest in it, what it needs to succeed, and what challenges it faces. If you can explain all of this to someone else in a concise manner, you'll know that you're ready to invest. Now, thank you for taking the time to watch, and if you found value in this video, be sure to hit that like button and subscribe to my channel for more great content. Trust me, you won't regret it.